Welcome to StraddleIncome. We're here to help you make money. Today is January 25th. It's Monday. It's the first day of the biggest earning week. In this week, there are going to be several big companies reporting earnings. Tesla, Microsoft, Facebook, Apple. These are big names in the industry. And it's going to be a very exciting week, and it definitely has an exciting start. So before I actually jump in and talk about the trade that I made today, first, let's look at a chart. As you can see from the QQQ chart and SPY chart here, the day really started very strong in the morning. Actually, the entire market has been quite crazy in the last couple of days. And when I first got up this morning, I was shocked how the market is being so strong. So there's a lot of good anticipation of this week. So many people are so positively thinking this week is going to be good. You know, this goes back to what I have been thinking. The stock market was pretty much dominated by institutional investor in the last couple decades. But starting from last year, it has shown that retail investor can dominate. The evidence for the hypothesis was on Friday. You can see the GameStop stock just being absolutely crazy. Nikola earlier last year. So a lot of people is having a lot of money in the stock market. The retail trader is showing their power here. And because it's a strong earning week this week, let's come back to this today. It has been a lot of anticipation of good earning reports on major cap companies, including Tesla, Apple, all those companies. People are so hyped up. Last week, Netflix actually put oil on the fire. You know, people are seeing Netflix can report such a good number with 10%, 15% increase. So anyway, coming back here, a lot of good anticipation on Monday, and then all of a sudden started to drop. This is very sharp drop. In 3 minutes, the entire index dropped 1.5%. This is very interesting. There wasn't any news. There wasn't any significant events. Actually, matter of fact, several of the big state has taken back the stay-at-home order. So that should be a good thing. But really, it dropped. So what my hypothesis, and this is totally my guess here, is somebody decided to calm the market. The people are saying this market is getting out of the control, so let's put a break on it. And they did. And because of that fact, the market dumped really quick in the last couple of minutes, and it killed a lot of the momentums for big major cap stocks. This momentum killing actually hurts somebody. If we look at the stock shares perspective, it doesn't change that much because the market pretty much closed where it opened. But if we're talking about options, leverage, a lot of momentums have been killed with this big drop. Actually, we can get into that later in the next couple of videos. I can make a tutorial about it. But really what happens here is the market dropped, and it dropped quite big and then kind of crawled back. Same goes for the S&P 500 index. Actually, for the S&P 500 index, the market closed higher than open. And if we take a step back and look at the daily chart, again, very powerful. This is just every time it touched the moving average line, it just rebounded. I don't understand this at all, but I guess I'll just listen to the market. Same goes for the QQQ. QQQ actually, also rebounded back. So net, very strong market, very bullish market, and it just kept going up. And if you zoom out a little bit further, look at where we came from. In March 2020, it was 164. This is 330. The entire index doubled. Same goes for S&P. 218, 384, less than double, but just absolutely crazy here. Okay, enough about the market. Let's talk about the trades that I made today. The first trade that I did today is actually about GameStop. So I didn't buy anything call bullish about GameStop. I don't know how many people here are familiar with the background of GameStop. If we look at the chart, and you can't even look at it, you have to zoom in really here. Basically, on Friday, the GameStop jumped from $42 to $75, highest point. And then today, it kept going to $159. So what I did around GameStop on Friday, I bought 2 of the puts. So let me show you GameStop here. GameStop, I bought 2 of the puts at $21. I paid about $45 each. I just don't think this thing is going to be sustainable. This is crazy. Somebody will take money out, and the market will, it will justify a little bit. So enough of that. What I did is basically play the bullish, inverse of that, and play the bearish side of that trade. So I did 2 of the puts for $21 strike price, and I paid $45 each, total $990. And today I closed one of the put. I got my initial investment back. I still have 1 more put left. I'm just going to write it out, see how it goes. It's going to be interesting to see how it looks. This is very fascinating to see. This is showing the power of retail investor. You don't want to piss people off. Next, I want to look at a little bit about the next trade I want to talk about is for Disney. For the Disney, I want to take a step back. I'm overall bullish about Disney for the long term, and here are my reasons. We have to look at it both from fundamental, technical side of the bills. From the fundamental, there are 3 reasons. Number 1, the Disney stock, because of Disney Plus, has really transformed the company from a media company to a technology company. So investors really liked it. I think a technology company is more scalable. I think Disney is going to be the next Netflix, at least. Okay, that's number 1. Number 2, the Disney stock is, they just have not been able to open any parks or other major theme parks around the world. The fact that the stock price kept going up, it's right now 176. It's actually very high if you look at their history. But the fact that Disney will open its parks in the near future, it gives me the bullish sentiment about this entire stock. Actually, California just announced that they will take down the stay-at-home order. So that's a positive sign. I think, it says that the government is seeing some kind of control on the coronavirus cases. So that's number 2. And the number 3, the reason I'm bullish about the Disney is because the Disney Plus as well. Disney Plus, this is the earning, remember, to report Q4 of last year. So it covers the Christmas and all the big holidays. And when people, they have some free time, what they probably usually did is go travel, but now they probably just stay home and watch a lot of videos, as you can see from the Netflix earning pop. So I think Disney is going to report good earnings as well, but the fact that Netflix reported such a big earnings, such a good numbers, it sets up a very good anticipation for Disney. And because of that, anything that's not as good is going to be bad. So the anticipation is strong, but anything less than strongly anticipated results will actually hurt Disney. So with that being said, I don't want to play earnings for Disney because I think anticipation has already been there. I don't want to play that. I just want to play long term. So that's the fundamental side. On the technical side, you can see from this chart here, Disney stock has been pretty much just consolidating between 165 and 183. And today is actually 171. So the last couple of days when Netflix popped, it helped the company by boosting the stock price a little bit, but now it just kind of came back down. So I think right now Disney is not something that a lot of people look at it because this week people are just so focused on Tesla, Apple, Microsoft, StarBucks, all those big tech companies. But Disney is something that just out of their sight, out of their mind. So I played the Disney long-term leap call contract. But let me tell you a little bit about this particular trade. This is not technically a call contract. as you can see, what the call that I did is for January 21st, 2022. I have been thinking about buying a $175 call for Disney. It expires 1 year out. So the price of that is $2,100. This is a lot of money for me. I think because you can see I have several different positions for Disney. I don't want to over concentrate it. So what I did is something called bull call spread. Basically, the idea behind that is you're buying it cheaper and you're getting less profit. So here's how to implement this. You buy a 175 call, which is usually at the money or at least close to be in the money. And then you sell a further out of the money call. So in this case, I sold a $210 call. By buying a call, I'm paying $2,100. By selling the call, I'm getting $1,000 back. So the net, I'm paying about $1,100 for the entire spread. By doing that, I lower my initial investment by sacrificing the maximum returns I can get. Because by buying a call, you can potentially have unlimited returns. But anyway, let me show you how it looks like. This is basically the setup, the risk graph for this chart here. What I'm showing you right here is if you look at the blue line here, this is the profit and loss chart for this strategy. I'm pretty much committed to sacrifice $1,100. This is my max loss. By my max profit would be around below $2,500. So this is my max profit, this is my max loss. And I start making money around $186 right here. This is the typical risk graph, profit loss graph for bull call spread. And as you can see, by buying a call and selling a call, I limit my maximum profit here. If you were just buying a call, you would have this chart just come here and then just goes up without this big segment, flat segment right here. So this is my strategy for the long-term bullish sentiment for the Disney. And I hope this information here is useful, helpful. Thank you so much for your time. If you like it, please subscribe, click the like button and the share button. And again, thank you so much for your time. I'll see you in the next video.